made a good, nice little commentary on the crude, pointing out how expectations are starting to change, and he's kind of looking a little more northward for some of this. I made some longer-term pricing issues here, so some we'll have to watch as far as the grains affecting on the grains here as well. The fact that over a third of our grain is priced off of what energy prices are doing here. In terms of the current situation, we're already getting some calls from these reporters on expectations for that November or December 10th supply-demand report. Just give a quick little review of what's going on to these numbers. Bottom line for corn, for weeks we had been running below normal. Here's the red line showing the this year normal is considered the blue line. Last week was still under normal here. So we're actually running behind the pace we need to hit for USDA on the export side. So we are going to see a number drop on exports on that report. So this is not any new information, though. One thing that we have to point out that might counter this is out on Friday was new ethanol production information. For the month of September, production was 20% higher than last year. For September, ethanol production was 20% higher than last year. That's gangbusters. USDA has us only 5% higher as their estimate for the entire marketing year. So our first month out of 12, we've already got one knocking this one out of the ballpark. So we're doing a great job so far in ethanol. In fact, this is so much larger, I'm going to pop our number a little higher on that December 10th report. I want to point out that as far as this ethanol production, we've also got some issues going on. We're going to hear more about it in the next few weeks on this ethanol, the blender's tax credit, which ends on December 31st. At the exact same time, we also have the expiration of our import tariff. So we're going to hear some talk in the next 2 or 3 weeks on these type of ethanol issues here. And so keep in mind that's going to be something we've got to watch closely here. I've got a nice little chart showing what the January, and keep in mind this is January to December, not September to August like we're used to. But for the government mandate levels, which are the bars in red here, keep in mind that for 2011, based on the federal mandate, we still have a jump plugged in, a 5% jump, higher than 2010. This is what USDA is using their entire number off of. They're saying we're not going to do any better than that minimum mandate jump. But so far, as we saw from here, at least for September, we got that knocked out of the ballpark so far. So just keep in mind that we are going to increase ethanol. Even without these ethanol tax credits, we will still be increasing ethanol usage over last year. So keep that in mind here, kind of counter some of the bearish influence which we're going to hear in the next couple weeks on these ethanol issues here. I don't want to throw a bunch of numbers that are in front of our faces here, but let's just look at what's going on here. The ethanol line, we've got 50 higher than USDA. That's 50 million bushels. Now we've just taken 50 off of exports. So right now our bias is actually to see no change in ending stocks right now. Also important, well, if we're going to be having no change in stocks and therefore stocks to use, it's going to be still at this very low number. And look at all this year as stocks or stocks to uses have fallen, prices have reacted. It's kind of interesting to see that even with our large price reaction we had in the past 2 or 3 weeks, this really isn't out of the balance here. The fact we didn't break $5, we're still in a clear uptrend in prices as stocks have been falling in prices. So just keep in mind that in terms of on the supply aspect, this is actually still a bull market, believe it or not. And also the guys who, we talk about these long-term charts, those are still looking like we haven't broke the big points of uptrend points here. So bottom line, based on these numbers, we're still bullish on corn. We could still hit up to 650 if we see another month here of steady. In fact, maybe a little lower in the next maybe by January or February ending stocks. We could see that 650 mark hit. Keep in mind that these stock use numbers, these are as tight as this June of 2008 period when we had this crazy market up here. We don't have the ethanol pricing or the crude pricing, but right now we got the stocks to use there. Real quick note on the beans. Numbers we've already known about for some time. We're way ahead of what USDA expected us to do, as shown by these red lines, clearly over the blue lines here. And to meet USDA, we're actually going to have to fall under normal. In fact, we're going to have to fall to this black line clearly under USDA's pace, or clearly under normal for the rest of the year. So bottom line is we're so far ahead of USDA's pace, we've got to drop down something like 20% under normal to even fall down to meet USDA's pace. So we're doing a great job on exports. As far as the other issue here, one thing I can point out with domestic side, domestic usage for crush, we're doing great too. USDA expects us to be under last year on crush levels. You know what? First month was up 20% for September. October was down about 4%. USDA says we're going to be 5% lower. So both of our first 2 months so far, we're already beating USDA's hopes. So what could happen here with this ending stock number? A little higher crush, a little higher ending stocks. We could see a good bite taken out of this ending stock number down to 142. This is as tight as just 2 years ago. Quite a good news here. So we've got some issues in front of us with this grain market this week. China's going to sell 8.5 million tons of grain just this week. We've got also China looking to sell 300,000 tons of soybeans on Thursday night. So we've got some overriding issues which are going to keep this market pretty much mixed and ugly all week. But in the big picture, as far as fundamentals, numbers are still pretty darn tight for both corn and beef. Over on the wheat, just want to point out that as far as wheat, we all know it's dry for the plains, and we have gotten some improvement here for the Midwest. The 6 to 10 day showing that in general we're still going to remain dry. One thing I want to caution us against before we get all too crazy bullish and hyped up on yield losses, I put together a chart showing good to excellent ratings at the end of fall. So we're going to have our last rating either last week or this week before we go into winter dormancy. And that was at 47%. And I put compared against yield. In other words, if we have a low fall period before dormancy, does that mean a low yield? Not really. Look at these other years we've got kind of laid out here. In general, there's a higher pattern where, yes, fall conditions may have an issue here, but look what happened to these other 2 years here just in the last, this is 2000 the current. So bottom line here is fall is not the best time of year to make your guess on yield predictions for winter wheat. Yield for winter wheat is made in spring, once we get those rains in late March into April. So we do have some problems, and there is a reason why wheat's not going down, but it's not enough to say we got yield damage yet. Look at all these years above 45 bushels per acre, just 3 years. 2 of them, yes, we had good ratings at the end of fall, but one's sitting out here. How about all these guys just around this 43 to 44? All these guys have almost the exact same yield area, but the ratings are crazy, 45 to 75% good to excellent. So ratings at this time of year don't mean much at all in terms of